Hello there, and welcome to episode 41 of Anne and Steve Talk Stuff, where an artist and an economist walk into a podcast to talk about strange things that make the world go round. And in the interest of people knowing who that artist and economist are, Stephen, would you like to say a few words about yourself?
Hi, I'm Stephen. I'm an economist at the University of Limerick, where I teach and I do research. I write for thecurrency.news, and I talk stuff with you, Anne.
Yeah.
That's one of the most fun parts of my week.
Well, I agree. I am an artist formerly known as a theatre artist. That stuff doesn't really happen anymore, but I do. I work in theatre and performance and directing and writing and music. And I also do this podcast with the marvelous Stephen Kinsella. I do another podcast with Emma Langford as well called The Limerick Lady. But sorry, I do cheat on you with Emma. Sorry about
I,
that,
I,
Stephen.
I'm. That's fine. That's fine. I'm completely comfortable with that. I think you have to be. You just, it's the 21st century. You have to be comfortable with it all. So I am.
Poly podcasting.
Poly podcasting. Poly
Well, in fairness,
podcasting.
on any given week you could be on any number of shows, so we're okay. We're adults here. Um,
We're all adults
I
here.
have to also I realize because this actually goes onto YouTube. I don't know if you realize that because the Zoom video gets put on YouTube. I should
Oh,
really tell people this, and I'm
okay.
so conscious that the corner of the room I record in is quite cold, and I tend to wear the same kind of fleecy top because it's really warm
Sure.
and I'm now conscious that someone might be watching this on YouTube going, she always wears that thing. But it's kind of my podcasting fleecy hoodie. So
I there's an amazing thing. Yesterday, I
mm,
saw this amazing post. This man categorized every single thing he owned for 3 years. Literally, like every time he wore a t-shirt, every time he wore a hoodie, and how often he wore a particular pair of shoes. It was kind of obsessive, but also like obsessively good because he charted it out. I love a good graph, and he really was like, the cost per wear of each shoe, and I was like, this is my catnip. Oh my god, and I was just reading it, going, wow. And it was such a weird premise of an article. I had to read it.
yeah.
Having read it, I was like, the world needs to see this. But
Oh.
somebody sent me a piece, an Australian news anchor. He wore the same blue suit for a year, didn't tell anybody, like, so on camera, on telly, same
Yeah.
blue suit for a year. No one noticed, no one complained, no one cared. His female co-author was getting letters in going, here are tips for you to appear more stylish. The lad literally wore the same blue suit for a year. No one cared, and I think you get a pass, and so do
Thank
I.
you.
I
I'm
didn't
I'm
actually know
enough.
this was on YouTube. Okay,
Well,
right.
apparently it is.
All right.
I regret saying that now because a lot of people might actually check it out, whereas I'm quite happy for people to listen to us. But
Yeah,
I
yeah,
don't
yeah.
dress for this podcast. Can I say I don't do anything visually for this podcast? But it's not because I don't
Hello,
love you.
hello,
It's just
denizens of YouTube, I
yeah.
guess. I don't know. I mean,
Perhaps. But come here,
yeah.
Stephen. I thought we would get right into talking stuff.
Mhm.
Because as usual, you're a busy man and we can just whittle the hours away and then we run out of time. But this week I got a message from a friend of mine and I texted you as well. And my good friend Roisin Stack, who also works in theatre, and she basically she read an article where basically it was kind of two things where credit unions were stopping taking savings because they weren't getting enough loans. That was one thing. She was like, what the hell is this? And the second thing was it's something I've thought about, not exactly the way she put it, but um basically a number of years ago, uh car insurance used to be higher for young men because they were considered more of an at-risk group. And then this was considered discrimination. So rather than bring the young men's premiums down to the same as anyone who wasn't a young man, be it a woman or an older man, they just brought everyone's premiums up. And it just was just lose lose for the customer. And her thing was that when applying for a mortgage, for example, they if you are considered an unsafe bet for whatever reason, if you don't earn over a certain threshold, you will not be eligible. And her thing is basically, look at my credit rating, look at my debt history. I have never missed a payment on a rental. And yes, so technically, maybe on paper, I don't earn over a certain amount, but I am a really, really sure thing. And her thing was like, is it not the same to discriminate against people who don't have the highest earnings but have proof of being good paying customers to their accommodation? And that was kind of that. I'm whittling it down. I hope Roisin is happy with that summary. So it was two things really. It was that thing about discrimination, inadvertent, against people who maybe earn under a certain amount, but will always pay their mortgage. Yeah, no, are actually paying rents way higher than a mortgage if they got one. And the other thing is about people not wanting to take any more savings because they need more people to take out loans. So that's my summary. What say you, Stephen?
Well, first off, Roisin is a perfect example of um, a really smart person asking a really smart question, because this is a really smart question. It gets to the heart of some of the major problems that we have in our country and probably across a fair bit of the world. So the way to think about it um, is in terms of risk, and I'm going to differentiate between risk and uncertainty. So risk is the probability that something happens. So you have a risk of falling down and breaking your leg, and you've got a risk of winning the lottery, right? If you, as
Mhm.
a conditional on you doing the lottery, obviously.
Yeah.
Um, so there's upsides and downside risks. When you insure anybody, what you're doing is you're pooling risk. You're taking Stephen Kinsella, the driver, who's a bad driver, and then therefore the risk of him crashing is high, and Anne Blake, the good driver, who's a safe driver, the risk of you is low, and you're pooling those things together, right? And
Mm-hmm.
you're saying, Stephen, you pay X, and you pay Y. We're going to put them together, and in the event that Stephen has a crash, we're going to pay out,
Mm-hmm.
and same for Anne. So you're always pooling it in. So think about premium payments as like adding, opening a tap in a bath and just adding to a pool. And there's
Mm-hmm.
a pool of, it's literally called liquidity, because the basic idea is a bathtub, and as people crash their car and need a claim, they take it out of, they just take a cup of the of the repayment amount, or the payout, and they just take it out of the pool, and then it's gone, right?
Mm-hmm.
The insurance company's problem is keeping the pool as high as possible, while also making a profit. Right,
Mm-hmm.
that's the basic problem, and that's why you always have insurance companies saying, "We'll do you a deal. Come on board." Blah blah blah, because they need more water in the pool, right? Because
Yeah.
because the risk is out there, and if bad things happen, sometimes bad people cause bad things, but
Mm-hmm.
almost all the time, it's just, you're driving along, and there's an accident, things go wrong, there's downside risks. You're very rarely insured for upside risks in life, but
Mm-hmm.
there is an interesting problem that raises, but we're not going to get to it now. So the question then is that, what's the difference between risk and uncertainty? Uncertainty is something that you can't plan for because it's never happened before. A risk is a repeated problem. So they know I'm a 42-year-old male. There have been many other 42-year-old males with my income class, my education level, my marital status, and all that kind of stuff. That um, they know for a fact, because they've run the experiment of what happens when a 42-year-old male with my income and my education level drives a car. The
Mm-hmm.
probability of me crashing a car is 1/2000 or something, right?
Yeah.
And so they
Yeah.
set the premium such that people like me who pay out, we crash 1 in 200 times, and so therefore, or 2000 times, and therefore they have to set the premium so that they don't lose money when people like me pay out. And
Mm-hmm.
they add those slices of people up. So 42-year-old men, 42-year-old women, 18-year-old men, 18-year-old women, and so forth.
Mm-hmm.
The discrimination case that Roshan was talking about it's statistically proven that if you're a 19-year-old male, you're far more likely to crash your car than a 19-year-old female. And so what the insurers were saying is, these people are costing us a fortune. We need to discriminate against them by charging them above average amounts, because when they crash, they cause huge damage there because they're typically driving faster. They might die. There's huge payouts, and that's causing everyone else to pay more.
Mhm.
Right? It's a perfect example of what economists call adverse selection. Say that you have a heart problem and you're going to go for health insurance. Exactly the same idea as car insurance or life insurance or boat insurance, whatever. Um, if you know that you've got a dodgy heart, you're going to go for the highest amount of insurance that you can get because you want to pay out for your family and you want to be covered and all
Yeah.
that kind of stuff. But that's a problem, because the person who's most likely to take out the most insurance is also the person who's most likely to have the most need for that insurance. And
Sure.
so I don't have a heart problem. And so I should never go with that insurer because my premium is going to be far, far higher.
Yeah,
Right.
sure.
And
Yeah.
so they're trying to avoid what's called an adverse selection problem.
Mhm.
Um, and it's a key problem in insurance. And actually, weirdly, today or yesterday, the first female Secretary of the Treasury in the US, Janet Yellen, was
Mhm.
confirmed, and only the second economist ever to hold that finance minister role, which is really
Really?
interesting.
Second economist.
Yeah, yeah, probably the most qualified human on the planet to hold that job, by the way, incredibly.
Wow.
But she's married to a guy called George Akerlof. George Akerlof won the Nobel Prize in economics. So you've got a Nobel Prize winner in economics who's married to, she used to be the most powerful central banker in the world,
Right.
and was also the chair of the Council of Economic Advisors. Like, when I say ridiculously qualified, ridiculously qualified.
Mhm.
But the reason he won the Nobel Prize is for thinking about what happens when I have more information than you. So you're the insurer and
Mhm.
I'm the guy who's with the dodgy heart. I actually have more information about myself than you do. So you need to treat me in a certain way, right? When I show up, I have to give you some information by law. And
Mhm.
then you figure out the risk to me, right?
Yeah.
And or my risk to you, which
Yeah.
is by the same token. So the discrimination part was that the case was, you can't discriminate against people on the basis of their gender,
Mhm.
even though statistically speaking, men are more likely, young men are more likely to cause this problem.
Mhm.
Therefore, that meant that the risk, which was sitting on the shoulders of the young men because they were paying huge premium,
Mhm.
that went down, and but the risk pool still needed to be covered, so
Mhm.
everyone else's premium went up.
Mhm.
Okay. So in a way, the legislation, while perhaps just in a legal way, from a risk sharing perspective, it's probably a bad thing, because it meant that young men who don't bear the costs of their own um, uh, mistakes, in a certain sense. Of course, they do if they get into trouble.
Mhm.
So so that's risk, right? And
Yeah.
so it's the probability of something repeated happening.
Yeah.
And you've got uncertainty. So there's a probability that a 42-year-old man might crash a car. Then there's uncertainty. A meteor might just crash in the door.
Sure.
I had a lecturer years ago, and what he would do is he would give an example of risk. He would just have two dice, and he would like roll them on an overhead projector, and everyone was super bored. And then one of his friends would come in, dressed like an Indian, and throw a frozen chicken down the aisle, and this frozen chicken would like bounce down the aisle, and he would go, "That's risk, that's uncertainty," right? And so the probability of you having a heart attack is one over something. The probability of somebody throwing a frozen chicken in the aisle, well, it's much, much lower. You can't repeat it. You don't have any basis for it.
Yes, of
So
course. Yeah.
so that's that. So then the question, the second part of her question is like, what's the story with these mortgages?
Mm.
And the answer is, the mortgages are done precisely the same as the insurance contracts. They're looking at your risk. And what they've seen is that people who have a certain income profile, there's something called the age earnings profile. So as
Mhm.
I get older, my income levels out and then goes to zero. or
Right.
near zero because I go on a pension. And
Yeah.
so you can think about it like a tall, like a hill that you're cycling up. Your income typically peaks in your late 40s,
Mm-hmm.
early 50s, and then it just kind of levels off because you're not getting another job, you're not more productive, whatever. And then you go to 65 or 67 or something, and you just retire. So what they're doing is they're looking at Roshan's income now, they're projecting it forward, right? And they're
Yeah.
saying, oh, okay, right. So the value of interest rates might go up and down. So let's say if the interest rate goes up by 2%, can
Mm.
Roshan still afford her mortgage? If it goes up by 3%, can she still afford the mortgage? And the
Yeah.
model says, well, people with this income profile, with this repayment history, typically default on an average of 5%.
Mm-hmm.
Because things go wrong. Life happens. People get sick, they die, they might need to be helped. They might lose their job. Bad things happen as well as good things.
Of course. Yeah.
You almost never need to insure against good things, because if Roisin or you or I win the lotto, mortgage paid off, job
Mm-hmm.
done, happy days,
Mm-hmm.
right? But the downside is what we need to work on, and that's why you have to have life assurance when you take out a mortgage,
Yeah.
right? And so because if you die, and you never know, you might get hit by a bus tomorrow.
Sure.
Now the probability is very low because none of us are leaving the house. But the point is, I mean, if a bus comes in through the second floor of this 3-bed semi-D, I'll go, look, uncertainty, as it crushes me, right? And
Sure.
there you go. So it's the same thing. So the model is paying it out, even though it's really clear Roshan can afford the mortgage right now,
Mm-hmm.
right? Because she's already paying more as a monthly stipend in rent, right?
Yeah.
Now, the real question is, why are interest rates so high?
Mm.
So Roshan goes for a mortgage. If she goes for a mortgage, I'm just going to actually pull it up now. If she goes for a mortgage um, in Denmark today,
Yeah.
right? Um, interest rates. If she goes for a mortgage in Denmark today, she will get a mortgage for 20 years at 0%. In other words, she borrows 200 grand, say,
Yeah.
she borrows 200 grand, she will pay back
Pay
200 grand.
pay two
Sorry,
hundred
I'm just reading
grand.
the rates now.
Yeah.
So if she borrowed 200 grand now, it's 2.35%. That's the best
Okay.
with KBC current account holders. I'm just looking at the unbiased website. I don't,
Sure.
not
And
shilling for big bank.
and
KBC does not sponsor this podcast. They just happen to have the lowest interest rate
but
on
if
the.
they want to, but come here. So I
KBC,
can't.
fantastic bank. Love
I do.
KBC. KBC. Hashtag KBC for the win. No,
The
they just
two
happen to have
point.
the
So
lowest.
what's 2.3
Yeah.
five
So
percent of 200 grand? I can't be doing.
yeah. So well, don't forget that. Don't forget that's while you might think that you're going to end up spending, like, oh, that's only 5 or 6 grand. That's okay. Remember, it's every year. So
Yeah.
you add it up. You add it up.
Yeah.
And that's a big deal. And then first time buyers, even more expensive. So they're 4.5% for Bank of Ireland. Yeah.
But and so this is the
Yeah.
thing, and obviously I'm not an economist and I'm not a person looking at these, but if you, I used to feel this before. We were very fortunate enough to buy our house. Was in my entire life, I have been renting for, at the time, like I've been renting for half my life, and in that
Yeah.
entire time, I have never once missed a payment,
Yeah.
ever. And I wasn't even earning that much. I'd be working cafes and pubs, but I never missed my rent. And um, yet you see people who earn a lot more money defaulting a lot more often because there is just a lot more permission for that in the higher the earnings. So is there any kind of an argument for looking at your history?
Yeah, I mean, they do look at your history. So if you go for a mortgage right now, they're going to
Mm,
ask you for 6 months bank statements, right? They're going to ask for wage slips, like 3 months wage slips. They're going to ask for a letter for your employer. They're going to ask you about any loans that you have, and all that like feeds into the model. And so
mm,
what's a model, right? Like, it's literally a mathematical model that
yeah.
says, it's a causal statement that says, if your income is above this and you have no loans, and you're
Mm-hmm.
you're you're 32 as opposed to 52,
Mm-hmm.
the probability of you repaying this is over 95%. Give the loan.
Yeah.
If those things aren't true, so take the exact same person, right? The exact same person, Stephen Kinsella, professor in UL, public servant, blah blah blah. So whatever my risk profile is, right? I'm 42 years old. Just move me forward 10 years. Now I'm 52 years old. The probability of an adverse health event for me is way higher. So men typically in their late 50s, early 60s, men typically have, if they're gonna have any kind of health scare, that's typically when it comes.
Mm.
So the model will say, well, hang on a second, according to what are called mortality tables,
Mm-hmm.
at a certain time, they might even ask you for medical data, right?
Yeah.
At a certain point in life, the body just starts giving up. It's
Yeah.
typically around then, you know. So I would be, even like on an income basis, I probably wouldn't be a risky proposition at all. But on an age related basis, age adjusted basis, I might be. And then I might have an adverse health outcome. So
Yeah.
it's not just about income as well, or repayment schedule. They do look at that data, and it does matter a lot.
Yes. No, I know. And I suppose her question, like, and as she said, she said in the voicemail, look, I'm just thinking out loud here, and this entire thing was adjusted. Now I know gender is much clearer. It's a much it's a much more kind of say, dare I say, kind of black and white basis to readjust a model. But uh these this age group, this gendered age group were being charged more or whatever, and then it was considered that's not fair,
Mm,
let's readjust everything. um and that there are people who aren't earning as much but basically can never despite, like, they will forever be paying these high rents that are way more than any mortgage they ever pay, and they will never miss a payment because they want to keep a roof over their head,
yeah.
and they will move their money to make sure. So is there an argument that of discrimination against people who earn under a certain threshold but have proven track record of being a solid bet?
Yeah. So not only is there an argument for it, so economically, there's a very, very strong argument for that.
Mm,
So let's say Roisin is paying, I don't know, 1,500 for her rent, but her mortgage might be 800.
mm,
Yeah. That's 700 quid that she's not spending in supermarket. She's not spending in the pub, she's not spending it on and she's not saving it either, right? She's not getting a pension for herself. All there are all these things that she's not doing
yeah.
because she's paying a landlord's mortgage, and the landlord's mortgage is very high. Why? Because the landlord took out a 5% mortgage a couple of years
Mm,
ago. So there's two solutions. One is that you actually lower the cost of funding these mortgages. Right? So
yeah.
the way a mortgage works is the bank, let's say you get a 20-year mortgage out. The bank gives you that money and says, we're going to give you 200 grand right now. You're going to pay us back at 5% a year for 20 years, right? Or 5% a month for 20 years. We're going to get most of the interest off you first. So so many people don't know this, but if you're paying €1,000 a month,
Yeah.
maybe only €200 of that 800 is the principal, the actual money that you borrowed. The other
Yeah.
800 might actually just be the interest
Yes. Yeah.
on
Yeah.
that. So the bank kind of gets its money out of you first,
Mm-hmm.
and those calculations can be fairly scary to see, particularly if you've got a big mortgage. If your mortgage is like, I don't know, 500,000 or something,
Yeah.
and you start paying it at 42, like you're not going to get into the principal until you're really into the principal until you're in your like 50s.
Wow.
But the 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 there is a very strong argument um, for uh, a set of products that is very, very, very cheap for the average person,
Hmm.
right? So if you look at it now in Dublin, you need to have like an income of 88,000 or something to a couple. So each of you have to have like 88,000 to make
Each or
that,
between you?
or maybe it's between you actually,
Okay.
which, and to afford like a 2-bedroom apartment.
Right.
Right. So Lisney auctioneers came out. Sorry, this is the Society of Chartered Engineers came out. Chartered auctioneers, excuse me, auctioneers. Don't know why I said it.
Auctioneers.
The Society of Chartered Auctioneers, engineer, came out and they said, yeah, 88 grand for a 2-bed apartment or something in Dublin.
Jeez.
And the problem with that is if you like, that's fine if you happen to live in like, Blackrock in Dublin, but the median income in Limerick is like 40,000.
Yeah.
Right? So it's not going to work down here, right? It's not
Yeah.
going to work in Galway, let alone or Cork. It's not going to, so
Mm.
you can't make a policy like that, and that traps people like Roisin in rental accommodation forever. Which might be fine. It might be her choice, but it also, like, if she wants to own a place, it means
Mm.
it's very, very difficult to do so. So the question is how to lower the cost of acquiring housing. There's two ways to do it. The first is you come up with a way to lower those interest rates, right? And so a new bank, for example, might do that, or a state bank might do that. There's no coincidence that the lowest interest rate in this market is being charged by KBC, the latest entrant into the banking system in this country, right?
Mm.
Um, the other way is by what's called financial innovation. So you might have something where the bank comes up with a product which says Roisin's paying, let's say she's paying 1,000 a month for her
Mm.
rent. Well, every month she's going to pay 1,200. Okay, and
Right.
that 1,200, the 200, or maybe 300 of it, so 200 from Roisin, but 100 from the government, actually goes towards the production or the buying of equity in the house.
Mm-hmm.
So after a couple of years, with the consent of the landlord, of course, the Roisin owns that house, right?
Yeah.
So she's able to demonstrate through a process that's helped by the government and financed by the government. Hey, listen, I can do this, right? And that sort of it's that kind of process where you start saying, listen, I'm going to build up an equity. It's called an equity buffer. I'm going to build this thing up. So I'm going to have 30, 40, 50 grand, but it's invested in this house,
Mm.
And so what that does, if you think about it, is that lowers the risk to the bank. It's like,
Yeah.
this woman is definitely going to pay this thing off. Roisin's ears must be burning, by the way. We're just talking about it
she
constantly. I'm
she'll
sorry.
she'll love it. She'll
I'm
love
sorry, Roisin. I apologize. Jesus. You
it.
know, I'm
It's
really
hey,
sorry.
our listeners like to
Yeah.
feel included.
Yeah. Well, yeah, they're definitely included today. So those two policy options, by the way, the new bank entrant lowering bank interest rates
Mm.
is a really, really good idea, and lots of people have discussed options for like public banks, metal banks, state banks, this kind of stuff, because fundamentally, again, like the bank borrows money to give to you,
Yeah.
right? And it borrows at a certain interest rate,
Yeah.
and then it tags on a bit, and then gives it to you, right?
Yeah.
And so, if a different bank didn't have the same cost of funding that Bank of Ireland, AIB, and so forth have, then they would be able to offer a lower interest rate, which is why the Danish banks can do what they can do.
Yeah, I was going to ask how
You know,
come you can do that in Denmark? They
yeah,
they
they can do it in
just
Denmark. Even like interest rates now are zero, near 0% for the state, for Ireland. This is why we're able to borrow so much and hand out so much in PUPs and all that kind of
and
stuff.
has there
You know.
been like and is there not has this not been proposed or is it just weird that we've been stuck with the centre right government forever and they just
No,
aren't
no. I
into
mean,
this?
it's been proposed many times. The question is, how does it actually work, right? So
Yeah.
imagine that there's a brand new entrant into the mortgage market,
Mm.
which says, "Hello, my name is, Steve Bank, and here at Steve Bank, we will offer mortgages of 0% to everyone." What happens to your mortgage and my mortgage? Like,
They
just
go
think
up.
about it from your own perspective. What would you do?
I'd move.
You'd move
I don't know. I'm not.
in about
You,
5 seconds. You'd be
yeah.
like, thanks. I don't know who you're with, but thanks,
Yeah.
AIB, I'll see you later. Right. And that's what you do. So
Mm.
it's a bit like, which would of course imperil the banks that we have now. Right. Because
God love them.
but you see, you say that, but they're state banks, right? They're part of the state in a certain sense,
Mhm.
you know. So who would end up paying for them?
Look, all
Yeah.
I'm saying is I used to live in Galway. It was how I met Roisin. And I remember my local bank, uh, just the bank bailout happened and overnight scaffolding went up and they just did it up. And I was like, Anyway, I'll say no more. Um, yes, go
Yeah.
on. I'll keep my biased, angry fist waving comments to myself at the moment. So yes, why can't like we've a housing crisis at the moment. We've people. I'm going to drop her name again, like Roisin, dying to own their house, not and to uh kind of being able to move out of a position of paying possibly twice what they are, at
Mm.
least a third more than what they'd pay with the mortgage. Like, why can't are there steps towards this we could take?
Yeah, yeah, there are. So one thing that we can think very carefully about is the generation of public housing. So public
Hmm.
housing is not social housing, right?
Hmm.
It's housing where you get a private company or an approved housing board, and it builds the houses, right, using very low interest rate loans, and it builds the houses for a certain cost, call it 300 grand, and it then will either sell you the house or rent it to you. They typically rent these things, so they stay in state ownership. That
Hmm.
lowers the price of everyone else's house. Remember, Roshan has to pay a very high rent because there's very few rental properties. So if
Yeah.
there were loads of other properties available, the landlords wouldn't be able to charge as much, right?
Yeah.
And because the landlords can't charge as much, everyone else's rent goes down. So it's a really good thing for the economy, because remember, every bit of rent you're not paying is money you're spending in the economy,
Yeah.
right? Or on your future self via pensions, etc. Right?
Hmm.
Um, the social housing, the best place to look at this is Vienna in Austria, and the beautiful thing about social housing is there is that it mixes people of different income levels. So let's say I could be in this beautiful apartment, right, and I have a high income, and you live in the same beautiful apartment just downstairs from me, and you have a low income,
Hmm.
right? I'm paying my rent, which is 1,000. You're
Hmm.
paying your rent, which is 1,000. But you
Hmm.
can only afford 500, and the government gives you 500.
Right.
Right?
Yeah.
So from the housing authority's perspective, the rent is coming in is the same, right?
I get you. Yeah.
And it gives this small company the money to keep the building up and running, right? So it doesn't become the council's problem. That was a big problem in our system with social housing, is that it's actually grand to build them. The problem is servicing the cost of them in 20 years time, right?
Hmm.
Because people have no incentive to keep them up a lot of the time. And then when when people go to sell social housing in Ireland, they deplete the stock of public housing. They take the value that was created by the state, take it onto their own balance sheet because they sell
Hmm.
it or they give it to their own kids, and
Yeah.
then they move on.
Yeah.
Right. So
Yeah. Yeah.
there's a break in the system there. Like fundamentally, if the state buys something, the state should keep it,
Hmm.
you know, or if the state decides to sell it, it should get a market price, but
Hmm.
it doesn't get a market price. Yeah. So
Yeah.
it's just, people say, oh, there's thousands of people, hundreds of thousands of people on the housing list. Like if I thought I'd get a house, I'd go on the housing list. It
Hmm.
it would be crazy, right? Because I'd have the opportunity to acquire an asset at a much reduced price, fundamentally, right?
Hmm.
But most people just want housing, so in that world, in a world where there's public housing, meaning it is the housing of the public, it's not there for poor people or rich people, it's
Yeah. Yeah.
just there. That lowers the rent for everyone else, and therefore lowers the price of housing, which lowers the amount that Roisin needs to borrow, which means she's much more likely to get it.
Okay.
Yeah.
Okay.
And so in a world like that, low interest rates, you want to have approved housing authorities or large areas building loads of housing, not shitty housing. This is the other thing.
Yes.
People who are like I'm not going to live in a shitty apartment. I'm just
Hmm.
not. I've got 3 kids. I've got a good income. I'm just not going to do it. Right.
Yeah.
Would I like to live in an apartment near the city and have all these, services beside me? If the apartment was nice enough, hell yeah, I
Yeah.
would. It would be fantastic. But there's no apartment like that. That's not a description that applies. If you live in Paris, if you have my kind of income in Paris, you can live in a very nice apartment, and it's
Hmm.
nice. It's not crappy. It's really nice, and you're surrounded by really nice services. I'm not pretending I'm Johnny Big Potato here. Check out how much money I have. My point is, I'm a middle class worker, right?
Yeah.
Um, loads of money.
Loads
Yeah,
of
that's not me.
money.
But my point is, uh, that kind of lifestyle is fine, and you could do it as long as you have the place to build it.
Mm-hmm.
So the Land Development Authority is chaired by John Moore, and actually a Limerick man.
Mm-hmm.
It has a remit to build public housing like
Right.
this. Some of it's like this. Some of it will be private housing where private developers build it. Some of it will be, social housing as we understand it. But I would really hope that we would see this, because the model works brilliantly. It works
Mm-hmm.
brilliantly. You The way to see this is, and I've done it before, make a graph of house price inflation
Okay.
in Ireland
Yeah.
and Austria.
Right.
One of them looks like a fat man having a heart attack, and the other one looks like a nice, smooth glacial pond.
Okay.
Yeah, because the house prices don't change. They're not affected by more people building or more people. It's just not what happens.
Mm-hmm.
It's a far more um, chilled out, regulated space.
But
And
we,
I
we, we,
think,
w- sure,
yeah,
that'd be no crack, Stephen. We like the old heart attack every so
it doesn't
often.
sound like fun at all. Yeah.
I realize I probably need to let you go. Do you have enough time to answer that quick question about not taking savings because you want to give out more loans thing, or is that a separate?
Oh yeah. So that's it. It probably is a separate podcast. But
Okay.
do you remember I said interest rates are really low?
Yeah.
Right. So there's a thing, but there's a difference between what's called the nominal interest rate and the real interest rate. The
Mm-hmm.
nominal interest rate is the one you see, right? So
Okay.
let's say it's 2.35%. That's how much it costs you to borrow money. The
Right.
real interest rate is that minus inflation. Okay.
Mm-hmm.
So let's say inflation is 1%. So inflation is a rise in the price level. Then, so if the nominal interest rate is 2.35% and the inflation level is 1, the real interest rate is 1.35%.
Okay.
Okay. We happen to live in a world where inflation is like 1%,
Mm-hmm.
but the interest rate that you borrow at is like 0.5%. Yeah.
Okay.
So take one from the other, you have the real interest rate of minus 0.5.
Okay.
So when you give the bank your money or the credit union your money, let's say you give them 10 grand,
Mm-hmm.
right? They hold that on deposit for you. The central bank is saying to them, you need, rather than, giving people deposits, you actually need to take money from them. Yeah. Because
Okay.
remember, the interest rate is not 1%, it's minus 1%. Yeah.
Mm-hmm.
So you give me €100, I give you back 99.
Okay.
Negative interest rates are a funny thing.
Yeah.
They're
Okay.
hard to understand, but they basically invert the rules of economics
Right.
in a really, really, really interesting way, because they mean that things like a 20-year-old mortgage 0% actually make sense, because if you're borrowing at not minus 0.5 and you're
Yeah.
lending it not, you're
Yeah.
actually making money.
Okay.
See what I mean?
Do you know what I would claim to see what you mean? I'm having kind of
It's pretty topsy-turvy, but
I'm having
that's actually why.
throwbacks.
And we will see, like, if negative interest rates were a reaction to the crisis, the idea is you lower interest rates, the cost of borrowing, you
Mm,
lower the interest rate from like 10% to 5%, then
yeah.
people will take out more money because it's cheaper to borrow.
Okay.
And they'll go and they'll do more stuff. They'll like set up more businesses or build more houses or whatever. And that'll stimulate the economy. And then the economy will go roaring up again. You'll see loads of inflation and people like, shit, well, jack up the interest rate again. Inflation will go down. That's the
Oh,
notion,
and the
right?
heart attack continues.
The heart attack continues. Exactly. So now they've basically pumped the interest rate as low as it can possibly go, because we
Yeah.
had the 2008 crisis, then we had the sovereign debt crisis, then
Mm,
things were kind of getting a bit better, and then COVID, bang, on the floor again, right? So interest rates are negative again, and
right.
they may well be for 5 or 10 more years. In
Okay.
a world like that, it's very, very, very hard to be a banker.
Okay. Once,
And
as I said before, God love them. Me heart bleeds.
sympathy for the
any
banker, yeah,
any
yeah,
lovely
yeah.
bankers listening, I love you, I'm sure.
Yeah, yeah, yeah. Well, next week, this pod- this this podcast is sponsored by the wonderful people at KBC.
And
You know,
Anne shuts her mouth.
yeah. I love
Listen,
bankers. I
I'm
would like to
so
retract last week's previous comments. I was
I'd like to retract
high on
any
fumes.
any opinions I have because I've been paid.
My
Uh,
opinions are literally for sale. Yeah.
Thank you for that, Stephen. I was having flashbacks to attempting honors maths for leaving certain having to drop out just
Sorry.
at the no. It's just there's a certain amount of numbers where my brain just, even though you were explaining it wonderfully, I just
Well, thank
start
you.
to panic. But listen, as always, lovely to chat to you.
And thank
And
you. And thank you to Roisin as well for the WhatsApp voice memo thing.
voice
Yeah,
memo. Yeah,
that was
yeah.
the first, I thought. I think that was the first time I've ever gotten one of those.
Really?
Yeah, I
Oh,
was like,
I'm a devil for
what?
them.
It was like the light from distant stars, you know?
Oh, I love them. I use them all the time. I'm so lazy. Sometimes I don't feel like texting, so
Yeah,
I
I
just
don't
send.
actually know how to use that one, but I will have a look. And
Oh, beware, Stephen.
I'll start, I'll just start sending you,
You're
voice apps. Voice apps, is that a thing? Is it a voice? Whatever.
a
Okay, sorry.
voice
Stephen
message.
invents a new product category by accident.
I'm gonna start sending you so many voice messages now,
Oh,
Stephen.
voice app. CEO of voice app. You heard it here, folks. This is where it comes from.
You're way ahead of the
Uh
curve as ever.
yeah. So in front of the curve here. So much curving.
Well, listen.
Look, thank you very much, Anna. Thanks to Roisin for asking the question. If other people have questions, ask. I'll do my
Stephen's
best.
mad.
I'll
Stephen's
do my
mad
best.
for he's mad for voice memos. So send him in
I'm mad for
voice.
voice apps. Yeah, this is my thing. But please, I don't think I do well with relationship advice. I don't. I think I can. If we can keep the, I could. I'm happy to answer Roshan's questions. Maybe we could. Maybe
I'd be
maybe we'll put that on you. And
I would be very worried if anyone contacted us about relationship
people
advice.
are like, I don't understand why Brad doesn't like me anymore. I'm like,
What's Brad's income?
what's Brad's income? Brad's risk profile is in bits, Circa. I'm sorry. I'm sorry. I'm sorry, Circa, but I think you dodged a bullet there. Yeah. Have you
Well,
seen Brad's
listen,
repayment schedule? It's for shit.
I'm keeping an eye on your schedule here, Stephen. I'm gonna let you go, and
Thanks a million.
I will talk to you next week. Thank
See you
you.
later. Bye.
Bye-bye.